Welcome to the VCP trading tutorial. This is a reliable pattern and often found at the base of massive price gains. What we're going to do today is look at what the pattern is, how it works, and some examples on ASX of how it has worked in blue chip companies. If you'd like a summary sheet of the patterns, the filters, and what to look for, click on the link in the description below. Also, you can like the video to support the channel, click subscribe for updates, and comment below to let us know how you're using the VCP pattern or what other patterns you use instead. Now we're going to have a look at the slideshow and move that over so you can see these charts that we're going to look at today and also the criteria, so the short list of how we're using and applying the VCP patterns. Start off with, it is a tutorial that we're running through, and here's the agenda of what we're looking at. What is a VCP? The ASX blue chip examples. We're going to see the massive gains out of the VCPs that these blue chips have provided. Looking at fundamental filters. So the financial aspects of these companies that we look for in the filtering process. Also industry scanning, which is a critical component of narrowing that list of top performing companies that are primed for that explosive movement. Also the technical formation. So you want to see what this pattern is, the aspects to look for within the pattern, and then also technical filters to narrow that universe down once again. A lot of people use software and start with these technical filters to narrow the gap, or the fundamental filters. Either way, we overlay them to come out with the VCPs that we look for. And then there's also the rules of thumb. Once we've narrowed that universe, we want to understand what we're most likely to see, what to look for, and some rules of thumb to have an understanding or a gauge of when we're looking at a VCP, how it would compare to others. Then there's the SEPA model that was put forward by Mark Minervini, who created the pattern, and then also taking profits. There's no point identifying trades if they don't turn into profits. So the aspect of how to round this trade out, round this strategy out, and using that to put money in the bank. Now, first off, we want to know where it came from or what it is. So the VCP is a reliable trading charting pattern that's often found at the base of a massive movement. And the person who coined it was Mark Minervini. He's 3 times a US trading champion, and he first entered the US trading championships in 1997. He won that investment championships and 2 other years as well. When he won with a long-only portfolio. So Mark won this using long stocks only. The reason that's critical is because the other competitors in the market, in the competition, were also hedge funds going long and short, as well as derivatives traders and other traders using margin. Now, long-only, non-margined, returning 155% for the annual return to eclipse and beat all the other competitors is a massive, massive gain, massive win. And it all came off the back of the VCP pattern, which he's written many books about, but we're summarizing this here in this tutorial so we can know how to apply this to ASX listed companies. Other companies as well, other exchanges, but we're looking at how to apply it to companies. Now, ASX blue chip examples, we're going to have a look at 10-bagger returns. The blue chip company in Australia now is Fortescue Metals. That's an iron ore miner working in Western Australia and one of the largest iron ore miners in the world. Now, their VCP that we're looking at is between August 2018 and January 2019. There's also 100% gains from Sezzle. This is a buy now, pay later company that had 100% gain after their VCP in August 2020 through to January 2021. We saw CSL. So CSL is a blue chip on the ASX, and they've moved from 200 to 320 after a VCP. When they were at 200, they were a blue chip company, and then they moved to 320 to be the largest blue chip company on the ASX. That happened in September 18 through to June 2019. Now, what we've got here is Woolworths and CSL. Woolworths is the next one. For more information on CSL and how that massive growth company moved in the last 20 years, we've made a different video that looks at how the importance of growth in dividends. So not just looking at growth companies, not just looking at dividend companies that are providing a great yield now, but the importance of growing that dividend consistently year after year after year shows how CSL got to be the most dominant company on the ASX. And it looks at how the yield of CSL in a $10,000 investment over 10 years has moved against other blue chip companies. So you can click on the link in the description below to see how that plans out. But we're focusing now on the trading companies on the ASX. And we've got another one here, which is Woolworths moving from $30 back to $44 after a massive drop. This is a multi-year VCP. So it went from August 2015 through to April 2018, a very long VCP, much longer than the other 3 that we'll look at. But they did take them back up to their former highs of around $44. Starting off with that VCP, whether you start from the highs on the chart here, sort of March, April 2015, or whether you started earlier, or whether you started from this massive drop that happened in October, that's entirely up to you. The point is that we're seeing a volatility contraction. So think of dropping a ball and then it bounces, and each successive bounce gets smaller and smaller and smaller and smaller. That's what we're looking for in the VCP. So whether you start the ball drop here or here, it doesn't matter. It is coming down to a massive contraction. Normally it doesn't happen in a bearish phase, and we'll get to that later. But we're showing here this VCP, one contraction here down to the first arrow of the lows, a rally, a second contraction that's far smaller, whether you're starting here or here, much smaller contraction, another rally up to some highs, and then another drop down here, this third arrow, a rally again trying to get back to those highs. And then the final one is smaller, much, much smaller. We're looking at this tiny drop here, the fourth arrow here showing the fourth volatility contraction, dropping the ball, bouncing once, bounce twice, bounce three times, and then the fourth time it comes and breaks the recent highs, which has been touched over this overhead resistance line 3 times. Whether you want to draw a head and shoulders bottom or other patterns, cup and handle, that's entirely up to you. We're focusing on the VCP 1, 2, 3, 4 drops, and then you can see down here the volume has reduced significantly. After the volume has reduced, it's broken out, traded above the overhead resistance, and then rallied. It started the rally around from the $27, $28 mark and then moved up to 45. There was a retracement. It did come back, was a busted pattern head and shoulders bottom, or did actually hit profit target after that, came back down to the support level and then continued back up to $44. That's the VCP pattern that we see here, and it did break out in Woolworths. We're going to have a look at CSL. This is the company that ended up being the largest on the ASX. They did move, and this is a logarithmic chart we should point out. See on the right-hand side, $120 to $150. The gap there is far greater than 150 through to 180, which is another $30 movement, and then each $30 increment you can see is getting tighter and tighter. The reason why we look at a log chart is because of this price move is so large. What ends up happening is that left-hand side of the chart pales into insignificance and all gets compressed together, and then we can only see the detail of the top end of the chart because the price steps become so large. But this is a percentage base that we're looking at here on logs. So we see it dropping down from about 230 into the first drop here, going around January 2019. That's the first arrow. It does come down south of $180 and churn sideways. Rallies back up to near $200 and then drops back down north of 180, 190 area. That's the second arrow, goes for a third rally and then a sideways congestion, and then drops down for this short movement here. This is the third in the VCP, and then we're seeing volume drop down here as it's sideways churn and some tight closes. Tight ranges then breaks out above that overhead resistance, similar to Woolworths, but in a much shorter time frame. We're looking at daily, we're looking at weekly movements here, much tighter, and then breaks over $210 and then rallies all the way up over 330. That's the rise that's come out of this VCP September 2018 to May 2019 on CSL. Now we move to more explosive ones that are leading thematics that many of us have more freshly in our minds, because this is buy now, pay later space, and we're looking at Sezzle, which is definitely in that group. And we've got 2 VCPs over this period. So we're looking at we're looking at July 2020 through to February 2021. The first VCP, you can see a drop here. Remembering these companies are far more explosive and volatile than the blue chips that we looked at that were already top 20 companies on the ASX when they were looking at the VCPs. Here we see a massive drop. So we're looking sort of $9, pulling back down to $6, rallies back up to $8, then drops down again, $7, south of $7. So there's the first bounce. Here's the second. Here's the third, much smaller, much smaller, between 8 and 7, and then tight closes. We're seeing low volume here. The volume has dropped off significantly. Then it breaks out above the overhead resistance and shoots up. So whether you call this a fourth contraction here, that's entirely up to you. And that does break out. So over that overhead resistance, big volume on the up run, moving from the $8 mark over here, 8 all the way up to 12. Very solid gain in the matter of weeks, days actually, days. What we're seeing, contraction then starts again. So this is this longer form contraction. We're going from this August, September, all the way through to February, much longer than this short VCP here in a matter of weeks, dropping from 12, coming down south of 6, rallying off the lows with a bit of volume, and then starting the next rally up towards $9. Doesn't quite get there and then drifts back down. We see it does hit a higher low here, over $6, and then a bit of a rally. That then fades again back towards that $6. We're trawling out a bit of a bottom here, then a minor rally up towards 657, 675, drops down again under the 6, undercuts, doesn't quite get as low as the first low, but we are seeing that ball bounce. So here's the first contraction, quite large, smaller contraction, and then a smaller contraction still, and then a smaller or about equal contraction. Then it enters the sideways churn with a very minor contraction up here. So 1, 2, 3, 4, this fifth contraction is much tighter. You're seeing much tighter closes, narrow bandwidth, volume has dropped off notably, so it has been trending down throughout this contraction phase. Gets quite tight here on the volume around December, January, which does happen seasonally in Australia. Then we see a breakout, breaks over this overhead resistance that we have been sort of that 650, 675 region, shoots up with some volume, and then starts that rally from about the 675 all the way to $12. Solid gain, 2 VCPs within sort of a 6-9 month period. Very solid movement from a leading industry, which we'll touch on in a second, is why that's important, critical for the VCPs. Fourth one we're looking at is Afterpay. The VCP, again, 2 here. So we're looking at a very volatile company, strong leader. This is coming off the back of massive gains coming. If we look at this chart for the 12, 18 months before, it's much further down here, much. The share price has already rallied exponentially. Come up here, just over $20, 23, coming close to 24, drops down 16, 15 odd dollars, and then a rally back up, sort of 16, 17, another drop, that then does lead into a much steeper drop. So we come from sort of 23 to 15, then we're going sort of from the 17, 18, back down to 12. So big drops, massive percentage drops, which we don't normally want to see, but because these are market leaders, highly explosive companies with a very strong thematic, we do tend to see that can be the exceptions to the rule. Another rally, much smaller, $11 coming up towards 15, retraces back down towards 11, rallies again towards 15, but the lows don't come down as far here. See, we've got a higher low that's happening in this portion. Now, whether you're looking for a head and shoulders bottom, maybe quite a loose cup and handle, that's up to you. But this is what we've seen: 1, 2, 3, 4 consecutive bounces of the ball dropping 1, 2, 3, 4, getting lower. Tight closes around here, some lower volume highlighted here on the bottom. And then we are compressing along the 200-day moving average as well, which is a positive to see. 50 days still above the 200 moving average. And then we do see that breakout and then rally up here. So we're going from just over $12, going over $24, 100% gain. We're going January, February, March, April, 4 months to go 100% gain, huge movement. Then that starts a second volatility contraction pattern, going from 28 down to $20. It rallies back again to 28, the all-time highs, topping out, and then only coming back down towards 24. So the first contraction brought it down 24, minor rally up to say 25, back down to 20, up to 28. Now it only comes down to 24 again, rallies back up, not quite to the high. So we've got a higher low now, and then it rallies even lower. So not to the second contraction, not the absolute low, but it is coming down sort of the 21 area. Then this congestion here is still quite wide and volatile for a normal company, but in reference to how it has been, the volatility that it has had previously, it is somewhat tighter. We do see the volume dry up in August. So too tight, low volume here, tight closes right at the end on the 50-day moving average, and then it explodes back over it with huge volume, going from $24 all the way up to $40, massive price gain, and that's after the VCP, very short period of time, late August through to September, hits those highs. Now we're moving over to have a look at the VCP criteria. We've seen 4 examples on the ASX. We want to know the fundamental filters, industry grouping, technical checklist. When we talk about fundamentals, what we're talking about is the company's financial data. And we'll have a list of that in a second, but this is what the earnings are coming out of the company. So profits, the margins, that's what we're looking at, how much money the company's making and how it's relative to the business. Number 2, we want to see industry groupings. This is critical, and this has been happening for over 120 years on ASX with the best traders in the markets using industry groupings. So we'll have a look at that. Then we've also got technical checklist. We'll run through some bullet points of whether you want to be doing that filter yourself, scanning, eyeballing, or whether you want to run computer filters and scanning filters. We'll give you a list there. That's also in the download if you want to click below to jump straight to that and then program that into your software. Now we're having a look at the fundamental filters. We want to see strong earnings from the company. Most stocks that break out of a VCP have fundamental and technical outperformance before the biggest gains. We saw that with Sezzle, we saw it with BHP, with Afterpay, and it also happened with CSL previously. Woolworths was the exception, but we used that for a multi-year VCP on a blue chip company that many people knew the name of. So with strong earnings, we're going to see good positive announcements coming from the company on a consistent basis. You want to see earnings upgrades, you want to see profit upgrades, you want to see revisions from analysts saying this company's exceeded our expectations. They've blown up well and truly beyond what we expected. The price target, we've now increased that. The next one we want to see is coming out of a bear market or correction, because as Mark Minervini points out, 90% of the big winners on the markets begin their surge here. So whether it's a contraction or a pullback in a bullish phase, so you have a 10, 15% reduction, the market comes down, a lot of these companies end up turning sideways as the market drops down, some sort of accumulation that we'll touch on in a second. Or it comes out of a bearish phase. We've seen that market timing cycle, and then as the market's rounding out a bottom, it may still be finding in price discovery, finding a further low, while some of these leaders just churn sideways. That is that final contraction in the VCP, and quite often is the precursor to a massive movement. As the market turns the corner, the market might not run hard, but these VCP companies definitely do. Also, 10 years since IPO, we're looking at recent companies to the exchange. They might not be brand new businesses. They could have been around for a few years before coming onto the exchange. Sezzle and Afterpay are two perfect examples where it's a new company, new industry, and they've only been on the exchange a couple of years for Afterpay and Sezzle. So be open to new companies is a critical component of looking for VCPs. Finally, small and mid caps. So we're looking for not the large caps like CSL and Woolworths. We've used those because they're familiar names to many Australian investors. We normally see the VCPs, those massive explosive movements, 50, 70, 100%, 400%, 1000% returns coming from small and mid cap companies. They're going to have a proven business model because we're already seeing the earnings upgrades that we noted here in point 1. So they're already proven business, but they've got scalable businesses, industries where they can grow their market share or rapidly increase their revenues because it's a new industry, just like we've seen with Afterpay, Buy Now, Pay Later companies. Now we move over to the example fundamental filters. Now this is one way that we do use to filter through the ASX quite quickly. We want companies that are profitable, so we use the profit margins of over 1% on the right-hand side. We want earnings per share growth of 15% or more. Ideally, it's far greater than this, but it can vary depending upon the industry. And we also want revenue growth of over 10%. That shows that it's a leading company. There can be much higher revenue growth that we do see in leaders, but what this does is quickly narrows down the universe of companies that we're looking at, and then we can apply other filters as well, whether it's technical or industry overlays that we provide in shares in play and find market points consistently as we're surfacing the ASX leaders. So they're just some examples that we can use. Other ones that we want to see are outperforming the market. So the XJO is the ASX 200, the ASX 200 top 200 companies, S&P. If the company we're looking for is outperforming, then it's a leader. If it's underperforming this index, then it's a laggard, so it's below the rest of the market. And that's relative strength. We want the relative strength of the companies that we're looking at to be stronger than the market and their peers within the same industry group. We also want to see earnings surprises, analyze positive revisions. We want to see growth, and we don't want linear growth. We want exponential growth. 4, 10, 52 is exponential growth. 1 year, the earnings might be 4% growth, then 10%, then 52. We want that to consistently be going up, but not linearly. We want an exponential rise. That's where you get the massive interest, the institutionals coming on board, and then that pushes the share price rapidly. That's a key component that we want to see in the VCPs. As Mark Minervini says, in general, 3 or 4 to as many as 8 to 10 industry groups or subgroups lead a new bull market. And this is something that we've seen many times before for over 120 odd years. This is what we surface in shares in play because we're consistently looking at those top performing thematics, then drilling down to the top performing companies, connecting them for better trading. That becomes our universe for finding VCPs, overlaying them for the timing of entering these top performing companies. Again, you can click subscribe for those updates. What we see is this thematic that what we're seeing from Mark Minervini is not a new theme. Coming down to the bottom left, Jessie Livermore was looking at this in the 1920s where he reportedly made $100 million of profit in 1 day shorting the market. Now, he used sister stocks for the majority of his trading. He did corner other commodity markets, but what he was looking at most of the time was a thematic. So whether it was steel companies, back when Carnegie was looking at the conglomerate of steel companies and bringing them all together in the United States, or whether it was railroad companies, other manufacturers, he noticed that when one company led the market and shot out and ran much higher, it didn't do it alone. There were other companies within that same industry and thematic that were moving along and might not have run as hard, but they did definitely move in a group, a concert, or what he called as sister stocks. We also know that Bill O'Neill or William O'Neill looked at this in his cancelling modelling. His consistent updates coming from Investors Business Daily and those reports, he is looking at strong thematics. He's looking at catalysts, just like Mark Minervini is. He's looking at new industries with cutting edge that are moving. This is talking about Reebok when they introduced women's fitness shoes. These are thematics that William O'Neill's looking at, and he still does to this day through Investors Business Daily. They're servicing the companies in the US. We're servicing them here in Australia, the top performing thematics and the companies within them. So it's not a new concept. Same with Thomas Bulkowski, what he calls the holy grail of trading. He's published many great books on trading, statistics, charting patterns, candlestick patterns. He's a phenomenal trader, great analyst. And what he has noted is that his holy grail of trading is noted that to have the best filter over the markets is looking for leading market thematics. Because if you find a leading company within the thematic, it is far more likely to outperform than a company that is standing alone. You might have a gold miner running rings around the rest of the market, but if the gold market is tanking, the rest of the gold miners are on the nose, it is unlikely to be the super stock that leads the market higher. Turn the tables, have the gold price moving in their favor, have other gold miners moving, and a lot of investors pouring money into that sector. That's when you have a market leader. So that's what Thomas Bulkowski calls the holy grail, and that's why we're surfacing these companies in the thematics. Finally, an extension on these is Chris Kacher and Gill their book where they published 18,000% return in the stock market. They call themselves disciples of Bill O'Neill because they did work with Bill O'Neill. And they spent a lot of time extending on another strategy that we'll provide a tutorial on in time, which is the pocket pivot method. And what they've done is extended on Bill O'Neill's filters, which is also including industry sectors and leading thematics with catalysts, and then drilling down to market timing on pocket pivots. So we'll cover that again. But all of these traders here for over 120 years, 120 years, have been looking at market leaders in the thematic side. So that is critical for VCPs as well. Now, industry scanning, we do know that market leaders also have a broader theme, can have broader themes like growth, value, small caps, large caps, and so on. Large caps often happen right at the end of a bear market and money gets flooded in with more speed, less tact going into big names for security. We saw it in Australia between 2012 and 2016, where the small and mid-cap companies ran rings around the rest of the market, which was pretty much stagnant in comparison. So we do know that other themes do surface, and that's what we also provide on Final Market Points as we're surfacing those thematics, not just the industries. Now we look at the trend template. This one we're going to move through quite quickly because the download below has these details and you can put this into your software for filtering. In general, the summary here is that the trend is moving upwards. You've got the 150-day moving average over the 200-day moving average. They're both pointing up. You've got the 150-day moving average above the 200-day moving average. That's an uptrend. 200-day moving average is trending up for at least 1 month, preferably 4 to 5. Still uptrend. 50-day or 10-week moving average is above the 150-day or 200-day moving averages. That means the shorter-term trades are actually higher than the longer-term average. That happens in an uptrend. Current stock price is trading above the 50-day moving average. Share price is going up over the last month, 2 months. Current stock price is at least 50% above 32-week low. This is important because what we're seeing here is a company that has performed exceptionally well and it's rallied high from its lows. Many of the best companies, the market leaders, didn't start leading from the very bottom. They already rallied 100 to 300% from their lows. From their 52-week lows, they're already significantly higher. If you want to have a look at the Afterpay chart, you will find this time and time again. Before it burst out and ran much higher, it was well and truly above its 52-week lows. Take out the COVID 2020 exceptions in March, but the rest of the market was on its lows too. Now, we do see that those leaders have been performing well and have already extended a strong return because their fundamentals are strong. They have been strong for months on end, and then there's been growing interest as they've reported more and more positive earnings and they've been revised upwards. We're getting more people investing into it to a point where the volatility contraction leads to an explosive move. You also want to see the current stock price within 25% or so of its 52-week high. Sezzle and Afterpay are both exceptions of this, and as you can see, it has worked out in their favor, but they are a leading thematic, highly explosive tech companies, high PEs, high growth companies, and that has also happened on the US with the tech space as well. So when they do retrace, they can fall harder than 25%, but we're going to have a look again at that chart in a minute to understand how close it can be. So the VCP technical checklist, we want to summarize this with the base building side of things. 2 to 8 contractions ranging from months to years. Woolworths had years, we had Afterpay with months. Retracement, you want to see that at a minimum, you want to see it around 25% from the highs. The closer the better, but you do need some sort of decent drop so that you can have that contraction. As the ball bounces, it needs to have a decent bounce. Otherwise, the small ones are incremental and can be seen on a daily basis. So say it's a 25% drop, then you from the absolute high. Then you have a rally a bit more, retracement of about 15%. It's less than 25% drop. Then it rallies some more. Falls once again, maybe 8%, 25, 15, 18. That's reduction. That's volatility contraction. Now we've got progressive volatility contraction happening on the chart. So the bounce is dropping and getting smaller and smaller and smaller. You also want to see that in volume. You want to see the volume drying up, and hopefully that sideways churn, that sideways congestion on tighter volume, tighter closes, tight weekly or daily closes. That's contraction, the volatility. That selling's been depleted. There's no more stock being dumped on the market. It's not moving from weak hands to strong hands. That transition has occurred. That's when we see that pressure is being lifted or no longer there. So when there's a void or there's a vacuum, when the share price starts to rally. We're still looking at the rules of thumb here, and we're looking at number of contractions. Now, most VCPs are 2 to 4 contractions. Sometimes it can be up to 8, but all along we want this to progressively be getting smaller. You want the largest drop to be furthest away, and then that tight congestion coming much closer to where we want to see that share price breakout. So VCPs normally form within months, but they can be up to years, like we saw with Woolworths. They are a rarer example. In Australia, we see VCPs, but we also see high and tight flags, which is a highly reliable and profitable trading pattern that works a lot with the small cap miners in ASX. They can have explosive movements of 100% and then a tight consolidation. This VCP can happen within a matter of weeks, sometimes a month to 6 weeks. So have a look in the tutorial for the high and tight flag that we've looked at before, because that's a different pattern in itself with a micro VCP after an explosive move. So do have a look at those if you're trading small mid-cap miners, because that is a critical and very reliable pattern on the ASX. Now to review on the Afterpay, we do see that drop. We saw 24% came down to $12, $11. So that was well and truly more than 25% from its highs. But you saw the volatility contractions were coming in, getting smaller and smaller, and then a sideways churn with some tight closes. Tight closes, lower volume. That's one VCP. The second VCP towards the right-hand side coming down, contraction, rally, contraction, and then these contractions got smaller and smaller to a tighter closes and low volume. That's what we're looking for. The second one here was within 25% of the all-time high. The first one on the left was not, but that led to a 100% gain, and then this one also led to about a 75% gain. So that's what we're looking for in those contractions. And you see 1, 2, 3, 4 on the left-hand contraction, 4 contractions. And then 1, 2, 3, 4 other contractions on Afterpay once again on the right-hand VCP. Also, both of them happening within a matter of months. Now we move over to the specific entry point analysis, or SEPA as Mark Minervini calls it. Critical point that we're looking here is you want trend, specifically an uptrend. Fundamentals, consistently improving earnings, revenue, and margins, which is the filters that we've looked at before. Strong trend, strong fundamentals, a catalyst. Institutional investors are very, very important to trading, especially small mid-cap companies. So what we do see on the ASX and surfacing in shares in play and final market points is we're finding companies that suddenly have an explosive move and they're moving within a strong thematic or trend. We do surface a lot of small, mid, and micro cap companies because we see price surges happening with volume spikes. That volume spike is often a large fund or institution deploying a huge amount of capital because they've applied research to the company that many other stockbrokers or no one else is publicly recording or reporting on, and they're deploying that capital to get set before they go out and talk their book, promote the stock, and then you see the news front page of the AFR, look at this micro cap that's doing so well. The institutional companies already deployed their capital. That's what we're servicing, that's what we're looking for. You want that institutional support that might not be public yet, but you can see the large footprints that they leave of dumping huge amounts of capital in small illiquid companies or low liquidity companies, small, mid, micro caps on the ASX. So that's institutional interest that we want to see, and that's a catalyst that Mark Minervini looks for. Other ones are new products, supply contracts, Afterpay, maybe signing with eBay, PayPal, other aspects like those large agreements that you do see, they can be a catalyst for the breakout. You also see a new CEO, appointment of board, or a drug approval if it's in the biotech space, say an FDA approval. You've also got entry points. So most market leaders provide at least one low-risk entry point where the VCP helps indicate the timing. So if you look back through Afterpay, Sezzle, and we did it with Woolworths and CSL, they all had lower risk entry points, buying close with a stop within a congestion point and then a massive upside potential or price target. That's a low risk entry point that we're looking for. And then critically, all trades come to an end. So we're looking for an end of a super performer They don't go up forever. We saw it with a tech boom. Have a look at any company over the last 150 years. None of them have consistently gone up forever. They all peter off at some time and fall out of favour and become laggards as the market cycles through new leaders, new industries, new economic cycles. And not every trade works out, so it's important to have stop losses for all trades. So when it comes to taking profits, Mark Minervini says, if we're short-term trading, what the share price does after we sell is irrelevant. We're just participating in a portion of the stock's share price continuum. That's what we're targeting to get in. That's where we take our profits. Once it hits our profit target or it starts to peter off from the trend, we stop out, take our profit, move our capital onto the next trade, and that's what we focus on. That's trading. Now, what we do is scanning the ASX, final market points. This is what we've touched on. We're consistently scanning the market. We're looking for top 6 companies in the best performing thematics or industries. That's shares in play. Each week we're bringing them out to market and reporting on what the best companies are on the ASX in that thematic. We've got technical analysis on a weekly basis. We're looking at indices, whether it's the US, ASX, NASDAQ, S&P 500. We might be looking at individual companies. We do look at individual companies on the ASX, highlight the charts that we're looking at, whether it's a thematic, what the fundamentals are, and how we're entering those trades. So that's technical analysis. And then we're consistently looking at leading industries' market dominance, looking at the news behind them, what the thematics are, what's pushing and pulling these businesses, economic forces, macroeconomic events that are driving these companies, because they're the catalysts that we're looking for in the VCP that Mark Minervini surfaced for as well. So that's what we're looking at in the VCP. That's what we're going to stop sharing the screen, bring it back to full screen for you. Thank you for joining the tutorial. There will be more on pocket pivots. There is another one on high and tight flags that you can click on in the description below. And to support the channel, you can like the video, click subscribe for more updates, especially VCPs and high and tight flags.
Thank you very much, Gary. We'll talk next week.
And you can comment below to let us know which trading patterns you're using.